The real opportunity is not with the family offices or hedge funds that operate out of the Middle East. The real money is in the actual sovereign funds in both Saudi Arabia and the United Arab Emirates. It's billions and billions and billions of dollars. They have not allocated to crypto yet. When that happens, you'll see it reflected in the price of Bitcoin. There's no question about it. And they have such long-term views in those funds and the funds are so large. Remember, these countries don't operate the same way as the US domestic countries do, although they're managed. Many of the people managing those Middle Eastern funds, the sovereign funds, are actually Western educated managers. And so they generally abide by discipline and principles of risk diversification. So they may have a mandate, for example, that no stock can represent more than 5% of the fund or no sector more than 20%. Those are diversification mandates that are used all around the world, and they do that there too. But when you're dealing with a multi-billion-dollar mandate, and some of these they're the largest pools of capital in the world, a 1% allocation is a tremendous amount of money. And so there's a whole bunch of people, and me included, heading over in November, and everybody is talking about not just Bitcoin anymore. It's what would a portfolio look like if, the managers are asking this of participants that are already building these portfolios. Give me an allocation of positions if I want to be exposed to Bitcoin itself, of course, but also be involved in decentralized finance and also own level 1 and level 2 chains. What does that look like? I mean, if you want to own Bitcoin, but it's not that simple. If you have a compliance department and you have the Larry Fink letter hanging over you, and everybody knows about the Larry Fink letter. In fact, everybody also knows that BlackRock has hired a chief ESG officer. And so if you are being serviced and every sovereign fund in the world works with BlackRock, pretty well all of them, you really can't go against that mandate. It's not going to work for you. You've got to solve it. And so the question is, you got to check the box on ESG or you can't play in the coin space if you're tied into those metrics. So it's not like they don't want to, it's they can't. It's the same issue about buying certain goods and services from banned countries. That's what the ethics committees stop you there too. I really work in this institutional world, and it's not like you can call up the chief compliance officer and have a dialogue regarding the merits of mining Bitcoin with existing energy sources. They just don't give a shit. They're not going to take the call. They're just saying no. So there's some pretty big forces at play. And when you talk about, if you'd only own Bitcoin at 8,000, now it's over 60,000 to a sovereign fund that's running, 30, 40, 50, 60 billion dollars, it's a rounding error.
Right.
They don't care. And at the same time, it's the greatest opportunity for those of us that have invested in cryptocurrencies is to solve this problem for them. I mean, it's not going to get solved debating it with the compliance officer. It's going to get solved when they can simply check the box saying this facility in Norway, this facility in northern Quebec, this facility in northern Alberta, and this facility in West Texas, where the places I'm looking at, mine sustainably as agreed to with the government. The government has certified this an ESG compliant facility. Then the debate's over. In fact, those are the very people that I'm going to raise capital from to build out these facilities because it solves their problem. The same compliance office that won't let the fund buy Bitcoin will put money in the ground to build a facility to mine coin if it's ESG compliant. Go figure. I'm really fascinated now by the different approaches on decentralized ledgers. And so I've got a lot of people on my team working on it. I think the NFT market is going to be absolutely huge, and I'm going to be a participant in it. And I'm thinking NFTs, not just on digital art. I'm thinking NFTs used to authenticate physical assets. The one I'm working on, because I'm a huge watch collector, and I know all the world's largest collectors and the CEOs of all the watch companies, is authenticating secondary market watch trading. I don't know if you saw that article last week. I think it was put out by CNBC. $20 billion a year of trading in the watch asset class. And the biggest problem, let's say I want to buy a Patek Philippe that went off the market 17 years ago, which I'm doing right now. a piece celebrating their 75th anniversary, I have to send it to a guy named John Reardon in New York to get it authenticated to know that it's real. The hassle in doing that, the cost of doing that, moving it from the seller in Hong Kong to New York City in Bond, having John look at it, open it up, make sure it's real, close it, send it back to the seller so it's in his physical hands, then do the trade. I could avoid all that with a watch NFT. Once that watch was put on the market, Reardon would do an NFT to it, approve it, certify it, and for the rest of that watch's life, and every time it trades, it's real. And if we have to pay back a royalty to Patek Philippe or whoever the maker is or the designer of the dial, that's fine. You can all do that on a smart contract. So should that be on Solana? Should that be on Ethereum? Should it be on a derivative of Ethereum? I don't know yet. That's the research I'm working on. I've done a lot of work on stablecoin because this was out of need. About 18 months ago, we took down our commercial real estate holdings, including here in Boston where I am, down from 31% of the operating company's portfolio. Remember, these are income producing properties, so it was a form of our way we made income. And the cap rates got so low here in Boston, New York, Detroit, Miami. We just sold it, including climate controlled storage facilities that we bought at 11 cap that were trading at 3.5 cap. So it was time to exit. So we sold it down to 8% holdings. The only buildings we didn't sell are illiquid or have issues around them. They house movie theaters and things like that. And we had all this cash. So we go to the cash desk and we say, okay, we have to park this cash while we redeploy it. And they offered us 23 basis points. And I'm talking about some of the biggest cash desks in New York. And I said, this is insane. You're going to give me 23 bips? And I'm facing 2.1% inflation. That's when we started digging into stablecoin, because that was the first time we started that dialogue with Circle and other entities. And then I called up our auditors and said, look, we're going to deploy some of this cash into stablecoins. And we chose USDC because we really like the compliance team over at Circle. Those guys understand our problems regarding compliance. And the auditor said, no way. You are not doing that. We're not signing the statements. I said, that's crazy. I want to deploy this capital. You won't sign my statements? No, we won't. It's not approved by the regulator. I mean, guys, we talk about crypto collectively all day long, but it is so early in the institutional world. It is so nascent. It's so not there yet. And that in itself is the giant opportunity. I mean, just stable coins alone would be a huge market if you could actually lend them out, even anything over 4%. Now, I assume when they regulate it, the demand's going to be so high, it's going to push down yields. But right now, you're talking 6.2% on a 90-day stake, which is phenomenal.